Corporate finance practice problem using Onenote. Convertible bonds, pure bond value, and falling stock price. Get ready, it's time to take our chance with corporate finance. Here we are in Onenote. If you have access to Onenote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side, the Practice Problems tab, down in the 1933 Convertible Bonds, Pure Bond Value, and Falling Stock Price tab. Also note, when using Onenote, look at the immersive reader. Our presentations will also be down in the text area, same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we have our information up top, calculations on the side, and down below in blue, we're looking at the convertible bonds, bonds which can be converted into some number of shares in common stock but are not required to be converted. We want to think about what will happen to the bond price with relation to the pure bond value when there's a situation of falling stock prices. So we have the convertible bonds outstanding, rate 8%, the par value at the $1,000, the conversion ratio, meaning the bonds can be converted into 32 shares of common stock. They mature in 18 years, and the interest is paid semi-annually. We have the stock price is at the $37. We're going to assume that 1 year later, the stock price falls to $21, and the yield for similar bonds is 12%. So let's start off with the starting conversion value for a bond here. We're going to say the conversion ratio is 32, and the starting bond price was 37. So 32 times 37 is going to give us the conversion value of $1,184. Then we'll look at the ending conversion value. At the end of the time period, or 1 year later, the conversion ratio is still at 32. We can still convert them to 32 shares, but now the stock price is only $21. Therefore, the conversion value is going to be that $672 versus the starting point of the $1,184. Now we want to pick up the pure bond value. So note what we've done with the conversion value is we thought about it from the perspective of what if we took this bond and we converted it to the common stock so that we can value the common stock because we know the value of the common stock because it's actually trading on the stock market. We don't know the value of the convertible bond because we don't have the luxury of a lot of similar convertible bonds trading on the market. The other side we can look at is the pure bond value, imagining a situation where we're looking at similar bonds without the conversion feature on it to see how the price would be related to it. For that, we're going to use the 12% for similar bonds return. So I'm not going to go over the calculation in terms of the present value calculations. Note that we do this in a prior section when we focus in on bonds directly. And we also look at present value calculations in a whole nother section if you want to focus in on that in particular. But when we think about the value of the bonds in general, it would be the present value of the interest payments and the present value of the amount at maturity. The interest payments then calculated at, we could see up top, we've got the 1,000 payments times the 8%. And so we would have 80, but then we're going to divide it by 2 because they're semi-annual. And so 40 for so many periods, which is going to be 18 years. But then we'd multiply that times 2 because it's going to be semi-annual 6-month periods. So if we were to take the present value of those payments then, and we'd use our present value formula, at the 12% rate down here, we would get to the 574.73. We do this in Excel, by the way, so if you want to go to the practice problem in Excel to see that calculation in Excel, you can do that. And then we would take the present value of the $1,000 at the 12% market rate, bringing it back as well, present value. It would get us to the $137.91. If we add those two up, we have the pure bond value at the $712.64. Now, at this point in time, notice, that's going to be lower than the original conversion value, at which time you would think that the bond price, the convertible bond, would be driven mainly by the bond price. But now, you would think at that point in time, the value of the bond would be mainly driven by the conversion value. But now, the pure bond value, the related bond value, if we were to think about the bond that is similar to the convertible bond, is now higher than the conversion value at this point in time, which may lead then to the pure bond value being a substantial factor when you're figuring out what the actual price, or considering what is constituting the market price of the convertible bond. So in other words, if we see here, we got because the pure bond value is higher than the conversion value, the pure bond value will have a bigger impact on the actual market price of the convertible bond. So in other words, if we're thinking about the convertible bond, the value of the convertible bond, we can't really compare it to anything else as easily as we can with basic securities like stocks and bonds, because those are trading on the stock market. We have larger markets. We can get a better idea of similar securities that are being traded. We can look at the common stock side of things with the conversion value, imagining we convert the bond. If that value is higher than the bond side of things, which it often is, then you would think that would be more of the driving factor in terms of what the market price is for the convertible bond. But if we calculate the pure bond value and it is higher, as it is in this case, 1 year later, to the conversion value, then you would think the pure bond value would be the thing that's kind of driving the actual market price of the convertible bond, or at least would be more relevant. So then if we're thinking the conversion premium, if trades at the pure bond value, so let's imagine then that this 712.64 is actually the market price then of the convertible bond itself, then we can figure out the conversion premium, which would be that 712.64, which we're imagining to be the market price, minus the conversion value, which we calculated up top at the 672, would then give us the conversion premium of $40.64. We can calculate that on a percent basis as well by taking that 40.64 divided by the 672, and that would give us, if we move the decimal 2 places over, 6.05%.